Hello, welcome to another edition of Nucleus Investment Insights. Today we're on with housing affordability. It's been a little while since we've run one of these, so just sort of, and given we've had some interest rate cuts, I thought it well worth running through just some of the big macro things that are going on in terms of Australian property, and really just sort of trying to dig in and look at the affordability stats, and they've obviously gotten better recently because, you know, I guess wages are increasing. Albeit not real wages haven't been so flash, but property prices have sort of come off a bit, and then we've been hit with this fall in interest rates, and so so just want to sort of look at what's going on, what are the big macro themes, and what does that actually mean for investment and you know, as an alternative asset class for most people in terms of what they're looking at. Just a quick reminder, everything you hear today is general advice, not personal advice. So if you do have any questions and you're looking for personal advice, you can certainly give us a call, drop us a line, and speak to somebody about what might be right for you. So with no sort of further ado about that, what I really wanted to, I'm going to start with this idea about, you know, whatever it is an interest rate. So I think there's a lot of things once you start sort of trying to put some numbers around housing aren't quite as simple as what it might seem. And so I've got a chart up showing a bunch of different interest rates in Australia, and sorry, it's not well labeled. And this is all coming out of the Reserve Bank of Australia runs statistics over time, and it's looking at the last sort of 5 or 6 years, and the red line on top is the discounted standard variable rate. There is a dotted line, a grey dotted line in there, which is the 3-year interest rate, and then the blue line is sort of my take on what I think the right number is. That if you walk in, if you're a brand new home buyer walking into a bank or a mortgage broker, the type of interest rate you're probably going to get as your lowest cost option. And what do I mean by that? Well, you know, the RBA's standard variable rate, they have a standard variable rate, and then they have a discounted standard variable rate, and they don't seem to. I think when they first started running them, they probably had a pretty decent correlation to what people were paying, but over time, I think banks are certainly trying to separate their customers, and so yeah, customers can get very different interest rates depending upon what your profile is. And so, you know, while there's probably not too bad on the average, but the other part is they're not too bad on the average, but they might not reflect fully what people are sort of seeing, and there can be quite big differences to what you see at the baseline. So the other thing is this 3-year rate, where particularly during the financial crisis, we saw that 3-year rate sort of drop to 2%, and whereas the standard variable rate was sort of still 3 or 4%. And so the idea that, well, if we're running off variable interest rates and it's 3 or 4%, well, that's not what people are paying when they're turning up to the bank. And so what we run is this sort of lower than, so, and we do some sort of adjustment to that, you know, taking the assumption that a lot of investors will get discounts on their standard variable rate. But what it's sort of saying really in a big picture sense is, yes, we've had a cut in the standard variable rate, but actually the 3-year rate's been low for the last year or so. And we've sort of already had more than 0.5% off the standard, the sort of 3-year rate that we're getting sort of at the start of 2024 was closer to 6.5%, and you're probably under 6% now on the 3-year rate. So you know, if you, depending upon how you want to measure this, but the way we're measuring it is saying it's the lower of those two numbers, and so you are probably, this interest rate actually doesn't make the interest rate cut, the official interest rate cut from the RBA probably doesn't make that much of a difference to a new home buyer, because they're probably going to go for a fixed rate anyway on average. So yes, so that's one part of it. The next part then is looking at the different measures we have for how we're going to value property. And the issue with how, there's lots of different ways, and I think the word valuation can sometimes be confusing. If you ask a real estate agent the valuation of the property, what they're really saying is that they're giving you a price. They're telling you, look, what is this? I've looked at other houses that have sold recently in your area, and I'm trying to estimate the price of your property, which, given they don't turn over very often, can be more difficult. What I'm talking about in terms of affordability measures and trying to come up with some valuation is this idea about saying, well, there's probably some update. There's probably some limit to house prices in terms of, if you sort of took this view that, look, house prices are going to double every 7 years, then you work your way out a few years, and all of a sudden you can have this, the thing that people are going to be paying $4 or $5 million per house in Sydney, and meanwhile their wages are a fraction of that, and there's no way they could possibly even save for the deposit. And there's this, you can sort of get these limits on things. And so what we try and track is sort of 5 different measures that we think will make are going to cause limits in terms of how high prices can go. Now, the first one of those is, and sorry, 3 of those are affordability measures, and 2 are investment type measures. And the first one we're looking at is the idea of mortgage payments versus median wages, with the idea that, look, if the mortgage payment the average or the mortgage payment on a median house in say Sydney versus the median wage in Sydney ends up being, whatever it is, 10 times the median wage, well, nobody's going to buy a house, or very few people are going to buy houses, just because they literally can't reach that standard. And so if we look at that over time, and I've sort of got 50-year charts here tracking back to into the early 80s, sort of late 70s. And if we look, say, and I'm just going to pick on the Sydney housing market, and I will show some of the other markets, and I do have a report coming out later on this week that's got all the major capital cities, if you're interested in a different market. But so you can see, or for anyone listening to the podcast, in terms of mortgage payments to median wages, they sort of vary between 30% and 100%. And they've been over this period where, if you look back in time, in the sort of 80s or 90s, when we sort of that sort of property spike and ultra high interest rates, that got to sort of 70%, and sort of worked its way up from sort of 30 to 40% up to 70%, and then worked its way back down again to 30 or 40%, and then spent most of the next few decades somewhere in the 50 to 70% range. And then we've been on this rocket ship for the last couple of years, well, sort of last 5 or 6 years, and now we're at sort of 93% currently, after peaking a little bit over 100 earlier on in 2024. So, I guess in terms of percentiles, you're where are we now? Look, we're miles above where we've ever been. It peaked out at sort of 70+% last time, and so it's you're sort of off the scale in terms of that. And in terms of I guess that we've been seeing, yes, wage rises have been going up, but actually real wage rises have been really weak. That sort of puts another sort of factor over it that I'll jump into in a minute. But on that basis, so I guess where I'm coming to is, and this is sort of true of a lot of the markets, is things have got a lot cheaper than what they were on this, over the last year or so, but they're still at levels that we never even reached, when we saw that sort of 17% interest rates back in the 80s, and it's still sort of probably double where we've been for most of the last 50 years. So that's one sort of measure. So and I guess what we're painting the picture of as well is that no one of these measures tells everything. It's a mixture of the two. So the first is, can people earning a normal wage actually afford a normal mortgage payment? And the answer based on history from that is there's a no. The next question is what about versus rent? And because we know we've seen these rapid increases in rent over the last few years. And so the idea here is what we're saying is, well, there's some sort of limit to mortgage payments versus rents, insofar as if the cost of a mortgage is 10 times the cost of renting the same house, then more and more people will just start saying, well, I'll just rent rather than buy if the cost is so extreme. If the cost of a mortgage ends up being less than the cost of renting the same house, then people are then obviously much more incentivized to get out and just buy a house rather than rent, and that will fluctuate. Again, I've got this sort of 50-odd year chart in here, and it's again, I want to paint the picture that Sydney's, particularly the housing market, is different to a lot of the others and ratcheted higher, but you probably see the similar trends, just lower numbers for a lot of the other places. Is that Sydney then basically if it falls, it very rarely falls below 100%. So whenever it falls below 100%, pretty much bounces back from there to say the cost of when the cost of a mortgage payment is less than the cost of a rent, house prices go up, and therefore it flips. That ratio comes back to something higher than 100. So it sort of, and it does seem to bounce between that 100 and 200%. So at 200%, just to keep in mind, that's saying a mortgage is twice the cost of renting the same a similar property. That sort of rocketed to well over 200% in recent months. I think we sort of peaked out at 230 odd percent, and it's fallen back down to 200% at the moment, which is still 94th percentile. It's been higher, but it's only ever in the last year, if you're looking back in time. So from that perspective, if you made the assumption that that's what's going to drive houses in the long term, again you come up with that same conclusion. The last sort of affordability measure, and I think the least useful, I think the top two are much more useful in terms of if you're looking at long-term prices and trying to work out where do you think this can go. I think that the mortgage payment versus the median wage and the mortgage payment versus the rent are going to give you a good feel about what people can genuinely afford as an ongoing payment. The property price to the median wage, we can just see that sort of, it's been a one-way street. It's gone from in Sydney, 3 times back in the 80s, back up to over 15 times now, and sort of peaked out a little bit higher, probably 17. I think it peaked out. I just don't know whether you can use this measure as something where you can actually tie an assumption to it. So whereas I think it's safer to say, let's say the mortgage payment to rent is that if you're going to pick a level, call it 150%, and say, well, I think that's a reasonable long-term expectation that people in Sydney buying houses aren't going to pay any more than 50% more than the cost of renting that same house. Or it'll come back to that sort of that's going to anchor your prices a little bit. The property price to median wage is sort of it's a measure of how difficult it's going to be to get in. But once you're in, it's obviously you don't have the same constraints. The top two measure that ongoing. Once I've bought that house, what's there? Whereas I feel like the property prices, whether you're going to borrow from others or get inheritances or whatever it is that's going to get you into the door, gifts from parents or whatever's going to get you in the door is one thing. Being able to maintain that is the more important factor going on. So so that's the investment, the measures that sort of track up that investment side. That tracks the affordability side. The investment side then is saying, well, what's the gross yield you can get on houses? And so from 1980 backwards back to today, we're plumbing the lowest we've seen. So gross yield 3% is as low as it's been any time over that period. Back the 80s, 90s, 2000s, it was 6 to 8%. Even for most of the 2000s, you're looking at sort of 4%, and 3% at the moment. So, and then keep in mind, this is gross yield. then I flip that around and say, well, let's go through and actually look at the most common costs you have, and time series of that over time, and come up with an estimate of what the net yield is. And if you look at the net yield, and then you take off the current mortgage rate to sort of give you this idea of as an investor, what are you going to get on these? That gives you a better feel for where we are as a position. So that's been a lot more different. So in the 80s, there was this huge negative yield. So yes, you could get an 8 to 10% yield on a house, but you had a 17% interest rate, and so you were losing a lot of money if you were borrowing just for that purpose, borrowing just to rent out, or losing on a cash flow basis. And then there's the part about in recent times when we saw those interest rates really fall to low levels, the affordability on a net yield versus mortgage rate was actually the best it's ever been when we're looking at sort of 2% interest rates. It was still, your net yield was still, pretty close to zero, but, it's fallen down to sort of, and it's actually sitting at the 50th percentile. So on that basis, we're actually no different to where you've been, over the last sort of 50 odd years in terms of those prices. And then just to give you sort of a quick, I won't go through all the different states and measures, but I did want to just give you those same figures, but for units, because you get some very different numbers on those. So from a unit perspective, mortgage payments to median wages tend to be more around that 50% level, and probably somewhere between the 40% and peaking out, back in the 80s when we had that 17% interest rates at 70%. So, and on that basis, we haven't really risen to sort of massive highs. Like if you look at the Sydney units, it's at 46% at the moment. Peaked out at 50 in recent times. Okay, so it's at the 75th percentile, but it's not that far off where it's been in that longer term range. And so, so I guess you'd have less concerns over from a longer term pricing perspective on those. If you look at the median mortgage payment versus rent payment, that then oscillates, somewhere. It's sort of similar to that 100% level, but probably rises nowhere near as high for units. So it's sort of more like 140% maybe you peak out at. We peaked out in recent times at maybe 160, and it's back to 130%. So still more expensive to get to buy a unit and get a mortgage on it, but not dramatically so. And the 64th percentile is like, a little bit expensive, but it's not significantly different to what we've seen over time. And then the property price to median wage, as I said, it's less of an issue. The other one is, on a yield basis, then things look better as well from that perspective. So you're at your sort of 23rd percentile, so still not good. The 0th percentile is the worst ever pricing from this perspective. So on a gross yield basis, it's still expensive, but not nowhere near as low as the houses. And then net yield versus the mortgage rate, 64th percentile, not terrible overall, a little bit expensive. So there's a whole bunch of questions. I might jump quickly. I'm going to run through what all this data means, and it was probably a bit of a longer intro than I expected, but I think that's hopefully giving you an idea of these levers we're using, the anchors we're talking about how to get to what we should expect in the long term for property. And I'll just go to a quick message, and then I'm going to jump into more detail about those long-term property thoughts.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. Before we get to the longer term, actually, what I did mean to run through is just give you an idea of what these numbers look like. Those same numbers look like across a whole bunch of different markets. And so I've got a chart up, and I'll describe some of the key metrics for people listening into the podcast, just showing houses and units, and then the affordability stats and the investment returns across all those. So Sydney houses, obviously, 200%. That sort of falls back down. Melbourne at 164. Back down to Perth at 125 in terms of those. So, and then units, sort of a similar type of factor. Melbourne actually sort of sits cheaper than a lot of the other cities at 113%, and Perth below 100% on that mortgage payment to rent for units. Then if you look at, and having said that, Perth is nowhere near as big as a rental market as say Sydney and Melbourne, just in terms of sheer numbers, and within rental market of units, doesn't have anywhere near as the number of units that you see in some of the bigger cities. Then when you go mortgage payments to full-time wages, now that Sydney's Sydney houses really peaking that out at 94%. Most of the other cities are more like 50 or 60%. In terms of the numbers, and then once you get into the units, you're now talking 30% in terms of the units. And I'll leave the others. If you're interested in the others, you can jump on and talk and have a look at those. So the issue with these, obviously, is that the numbers themselves are of interest, but you sort of want to know where they've been over the longer term. And so that's where I've got a chart up, a table now, just showing where they sit in terms of percentiles versus that last 50 years. That we're running through those charts. And so, while most of those are lower, say, your Brisbane was much lower than Sydney for all those measures, it's still actually, pretty close to its all-time peaks. So, it's either at the 96 to 100th percentile in terms of saying it's at the most expensive 4% it's been in for all of those measures. So, and that's true for houses pretty much across the board. Perth's a little bit cheaper on some measures, but mostly higher on mostly similar levels for those. Then when you get into units, it's a much more mixed bag. So, Sydney's is sort of at the 60 to 75, 60 to 75th percentile. So expensive, but not at nowhere near all-time highs. Melbourne's actually pretty close to longer term averages, and then Brisbane, Adelaide Adelaide actually looks on the unit side. Adelaide looks like the most expensive. And what I mean by that is the absolute numbers for Adelaide are much lower for all those, but it's relative to its own history of where it's been. It's looking a lot more expensive. And then finally, those net rental yield, less interest rate. The units are actually looking cheaper than average in most measures on those bases. So that's those. And then finally, just a quick one that I look at is the 3-month change in those valuation ratios as well. So so trying to get a feel for that. A whole bunch of questions. I'm actually going to jump in and I'll answer these questions shortly. Because I just want to run through some of these other sort of bigger, longer term factors that I think are well worth factoring in or well worth thinking about as we're trying to come to these longer term expectations for what we can think from for property prices. First of all, mortgage rates. So they're at the 24th percentile now, so quite low. And we're obviously expecting mortgage rates to go lower as well. So I guess the big picture here is, look, it depends on how normal we think, including the 80s and early 90s into this analysis is. There's certainly a big correlation between all those measures I'm talking about and the mortgage rate. If you thought mortgage rates were going to normalize to their longer term, to say their 50-year average, then mortgage rates are going up another 1 or 2%, and so that sort of means all these affordability stats look terrible. If you took the view that actually, the early 90s are anomalous and maybe we need to cut those out, and that potentially, if you did that, then we're probably closer to sort of a normal range at the moment. And then the question really is, if you think we're going into a higher inflation environment, tariffs all over the place, less trade, disruption, all that type of stuff, then you'd be arguing mortgage rates are structurally going to be higher than we've seen over the last few years. Otherwise, and that's going to make all these affordability stats worse. Or the flip side is you're saying, well, no, actually, we're going back to China's going to dump cheap products on Australia. We're tied to Australia. We're tied to China from an export perspective. So growth's going to be pretty weak in Australia, and mortgage rates are going to be heading down over the next number of years, which is, I think probably it's more in tune with what we're thinking from for the next couple of years. The question is just, if you start extending that out, whether that falls, whether that sort of continues. Sorry. In terms of inflation's pretty low relative to that last 50 years, but albeit higher than what we've certainly seen over the last 20 or 30. And rental inflation in particular is still pretty high. I think the spot measures. So the way they measure rental inflation as well certainly has a lag within when you're looking at, say, the Australian Bureau of Statistics, because what they're taking into account is that most people have longer term leases, and so when rents go up, say 3 or 4% over a 1 month period, call it, let's say there's a big jump in rents, they're up 3 or 4%. That actually isn't going to factor through to everyone with a lease for another year to year and a half before that finally rolls through to everyone. So the other side though is that we have started to see some rent increases taper off and stop rising, and that's something which we're not going to see in the statistics from the ABS for some time still. So there'll definitely be a lag before we see those. Your other main measures we want to look at is the wage growth. Now, in this perspective, pick your poison. I've smoothed these out into 3-year average wage growth, just because the actual data series itself can be a bit bouncy, and I think you can lose track of what's going on with sort of short-term fluctuations. But if you look there at 3-year nominal wage growth, so what are people actually receiving? That looks all right. We're back to sort of longer term averages, basically back to average. That actually even slightly above average on that basis. But if you look at the 3-year real wage growth, so you take off inflation, we're still plumbing these debts of negative real wage growth over the last 3 years. And very low in terms of the numbers for that. So I think there's if we're going to make estimates about where we think these things are going, so probably should have painted that picture a little bit more. So if we're painting a picture of, okay, what are mortgage rates to wages going to be? If we're picking some levels and saying, well, say for the Sydney market, we think 50% is the right level over the longer term, then having some sort of estimate about what we think the real wage growth is going to be is important, and inflation as well. And so that we can actually say, well, are we trapped in the current one? Are we going to be sitting in this low growth environment where wages are really weak? If so, you have to expect less from property prices. If we're expecting to go into this really strong wage growth period, well, now we can start expecting bigger increases in property prices. And I guess where we're flagging that is wages have been weak. The RBA keeps forecasting this wage rebound, and even now they're talking about concerns about is wage growth too high? But the issue we've got is real wage growth is terrible, and so it's sort of, if you've got the RBA clamping down on wage growth that's running at sort of 3 or 4%, and in the meantime, real wages going backwards, that's not a conducive environment for great economic growth. And then the other one is rental growth, and I do want to highlight here is the real rental growth we've seen it's at the 100th percentile. We've never seen real rents grow as fast as they have. nominal rents we've seen a couple of times, sort of back in the 80s. And over the last 50 years when I talk about this data. So nominal rent growth is a little high, but real rent growth is the one that's really rocketing. If you looked, say, at real rental growth if you cut out the last 18 months to 2 years of rental growth, and you looked at real rental growth over, say, a 20-year period, you're talking pretty close to zero. So basically rents growing at basically inflation. So the environment we've seen recently is very different. And I think that should certainly factor into this thoughts about, okay, if we're going to be factoring mortgages versus rents, we need to factor in, are we expecting this growth, this environment where rents just grow far in excess of inflation and wages, or are we talking about a more normal scenario within that? Right. So, okay, so I might jump to some of the questions, and then we'll get to the model. And then there's an online calculator for all this that I'm going to run through, sort of showing you some of these estimates. So first question from Leo: rental yields lower than government bond yields. In the rest of the world, that'd be considered too low. How do you see this panning out in the Australian context? Look, the issue with the Aussie yields is you don't get negative gearing elsewhere, and so I think Australians have a certain tolerance to rental yields, low rental yields. We haven't seen a meaningful property decline for, the 1990 was the last time we saw a real meaningful sustained property decline. And so we're talking 35 years, and that's a long period of time, and people get used to the idea that property prices go up, and you don't have to go far to find plenty of people that talk about property prices always going up. And so I think within the yield, within the context of that yields and saying, how low can they go? I don't really use those as a measure to try and tie house prices back to. I think I probably made the mistake of doing that, 20 years ago, thinking, well, people will demand some sort of proper return on these. But the fact that you've got discounted capital gains or zero capital gains if you own your property, plus you get negative gearing. Australia really has put its thumb on the scale in terms of pushing people into property. Plus, that the age pension and basically saying if you're old and you don't have if you're old and you don't have a property, then you're disadvantaged. All those measures that sort of push towards people just not caring as much about the yields in Australia. Questions: how will upcoming housing policy reforms impact property investors, particularly tax incentives, negative gearing, and maybe capital gains tax? I wish I knew what you're talking about. I guess my concern is that how many years ago we're talking maybe 6 years ago that we saw Bill Shorten run on some changes to houses in terms of bringing them back to more normal levels. And the Liberal Party ran sort of dead against that. I think the Liberal Party will be dead against changes to house prices and changes to house price tax incentives, and if anything, they're probably going to try and add more. Labor Party tried it 6 years ago, failed miserably, and so I think it's on the shelf for God knows how long. Maybe another decade or so. I think the best bet you'd have is maybe some rental, some things to try and get house rents down. But I think neither party is particularly interested. And don't want to blame completely the parties. I think the population in Australia is very pro breaks for housing, and so anyone who pops up suggesting that they might make some changes is probably not going to be electorally attractive to most. So not a lot on that one. Is there any catalyst for house pricing affordability to normalise? Look, I do think on the mortgage to rent and the mortgage to rent and mortgage to wages, yes, I do think that is those ones, you will come back to those longer term ranges. You can spike to these higher levels that we saw in those house prices. So let's say we're talking about Sydney, and it's the affordability measure is somewhere between 100 and 200%, say, of your rent versus your mortgage. Is that when it's 200%, I do think people genuinely start to look at it and go, well, just a minute, it's going to cost me, $8,000 a month to buy something and pay off a mortgage, or it's going to cost me $4,000 to rent the same property. At that level, I think it genuinely starts to make a difference, and not in the very short term, but I think that will. I think that is a genuine anchor that brings it back. To infinity and beyond, how can private investors do their bit to fix the housing shortage without losing out on a solid return? Let me think about that one. What can you do? Building property is important, but there's property developers left, right, and center falling over, as we speak, and so I think incentives to be able to build property at a reasonable incentives to be able to build property more easily, I think is important. And there is this talk about there's a NIMBYs question about blocking development and things like that. I think there's, from my perspective, if you had a measure to try and make building sort of a certain types of pretty stock standard houses much easier and harder to be for people to come up with objections to, then I think that would be beneficial. I get for people that, if you're living in a bunch of houses and somebody wants to put up a 20-story apartment right next to you, that that there's scope for whether neighbours should be able to infringe upon the rights of the people who want to do the building. I think there's a certain element to that. I'd love to see some more some more pressure zones, I guess, in terms of, zones where you could depressure that they do allow a lot more development. But I also think within normal property to say, okay, well, look, if you're a particularly litigious neighbor, can you just tie up the person next to you who's trying to build a relatively stock standard development that sort of fits within the rest of it? If you get rid of a lot of that, I think that would be beneficial for that housing part. If interest rates fall another 1%, what we'll do to affordability, I'll actually bring that up on some charts for you. What cash? Question quick for one from Leo. Economists forecasting higher inflation and interest rates going higher. What cash rate would crash? Sort of 20% crash to Aussie housing. Well, this is a tough one. Look, I would have thought if you had asked me if you had gone back 2 or 3 years and spoken about a 3 or 4% rise in interest rates and not a lot of change to a lot of these other factors, so poor real wage growth and things like that, I would have thought that'd go close. I think the major thing for housing is unemployment. I think if you saw a reasonable spike in unemployment and you saw a slowdown in the amount of immigration into Australia, that's really what would spark, I think, a more of an issue for houses than interest rates. I think interest rates in themselves, people, as long as they have a job, will tend to just buckle down and stop spending money elsewhere. It's when interest rates are high and there's a bunch of job losses and people just have to give up and say, look, I just can't afford it. I haven't got a job. Just got to get out. That's really what sort of drives those housing crashes. So within that, I will, let me go one more message, and then I wanted to jump into some of these longer term thoughts on and showing you the calculator and how you can play around with some of these assumptions yourself.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Okay, back to how can you do this yourself, and how can you look at these factors and sort of try to come up with your own estimates of what you think in terms of property? And I think this is sort of a scenario analysis tool we've got on our website under the resources menu. And what the idea is, there's sort of 4 steps to this. We're going to put in some the details of the property you're looking to buy. We've got what you think the economic outlook is, how you're looking to forecast, and then sort of have a look at those forecasts and play around with a few things. So first of all, you can jump between units and houses and some of the key sort of markets in terms of, and that will give you the rents that sort of approach that it'll give you the same rental yield you get for that market. So if you pick Perth houses, you'll see those rental yields come through. But let's say you're saying, look, I'm picking the Melbourne market. Let's say, I'm thinking about buying a house. It's going to cost me whatever, 1.3, and I'm going to rent it out for this amount, and either as a yearly, monthly, weekly sort of rent. And you say, okay, great, I've got that. Now, what type of economic environment? You're either looking at this sort of negative economic environment with really low inflation, poor wage growth, but really low interest rates at the same time, so some of these are maybe not be as bad as they sound for property, because a lot of this is interest rate bound. Then we're sort of talking about this low growth, and if you put your mouse over the eyes, you sort of get the what these standards are, and then you'll have the chance to change this later. Or you can sort of go with this property paradise where rents go up, interest rates go down, and everything's great. But let's just say I'm going to pick this sort of this moderate growth rate with 2.25% inflation, 0.5% real wage growth, 1% real rental growth, and mortgage rates at about 5%. And so we hit that, and then we come in and say, okay, well, let's have a look at this. And again, I've picked the Melbourne one this time. So I'm going to pick a forecast method. So let's say I'm going to go with this mortgage cost to rent. Then I'm saying, okay, well, here's this time series over time where the mortgage cost to rent, again, for Melbourne is it's not quite as high as the Sydney one, but somewhere between 100 and 200, and sort of peaks out at that, the 30-year average is 1.3. The 10-year average is 1.55. So let's say I go, yeah, look, that sounds about right to me. Say I think it's going to come back to so the long-term mortgage payment to rent is going to be 1.5%, 150%. Having a mortgage is going to be 150% more expensive than having a rent in the long term. Or you could pick, say, mortgage cost to wages and say, I think it's going to be 50% of the median wage or whatever. So I picked that, then I jump through, and it then says, okay, well, here's what would happen with the property. Given we basically assume that we go to that over the first couple of years, and you go, if you had no debt on that property, then you sort of start from zero, and over that sort of 10-year period, you're going to make about $100,000 out of that. And keeping in mind, it's a $1.1 million house at a $200,000 deposit. What it's saying, though, under that scenario, if you've got debt on that, then you're dropping sort of in that first couple of years, say 120 grand on that, and then gradually working your way back up and ending up back below where you started from from that perspective. Now, keeping in mind, the property price has gone up. It's just that where the return came from is the interest cost, and that's what this next chart next to that's showing. Is that you go, you're basically investing 200,000 because that's what your deposit is. Your entry costs are going to be about 70 odd grand, and we've got calculators that sit behind that. I'll show you some of those a little bit below. You then receive, almost $500,000 in rent over that 10 years. Your property costs are about 150 grand. You've then got, 600 grand worth of interest costs, and your property goes up by 300,000, and you got your exit costs, and net you come out. You started with 200,000, you come out with 179,000 at the end of that time period, based on that sort of scenario. And then if you want to get into those details, you can then sort of go, let's have a look at those assumptions. And each of those assumptions, you can sort of see, okay, there's my inflation. And you can go, well, what happens if I do think it's a high inflationary environment? You go, okay, well, let me say it's going to be 3% rates. Average wage growth, this is a real one, 0.5%. Yeah, that looks sort of in track with history. Maybe I think it's going to be lower. Maybe I think it's going to be, higher inflation, lower wage growth. What's your rental growth going to do on your property? What's your mortgage interest rate going to do? We've got a whole bunch of these property assumptions in terms of, that's that one we had before, but we go through and go, well, here's your assumptions on landlord's insurance and body corporate if it's a rental property, and rates and repairs and releasing costs and accounting, and if you want to run it through an SMSF, you can add on some of those costs and everything like that. But the defaults should be pretty right. But if you've actually got something you're looking at yourself, you can go through and then sort of say, adding in these extra costs. So for example, a kitchen, for example, probably going to cost you 15 to 30 grand, and you're probably going to have to replace it every 15 to 20 years. So maybe sooner. And so there's probably at least $1.5 grand depreciation you should be factoring in every year. And so there's those types of things, and then the exit costs. And a lot of those, keep in mind, anyone who's owned property will know that your ongoing sort of fixing costs tend to be almost nothing for long periods of time, and then horrendous amounts of money that really hurt for short periods of time, and back to not much. But so I've put in a couple of those changes: higher inflation, lower wage growth, and then I sort of recalculate that, and that will then go, well, actually that's actually better for me, as long as interest rates didn't change, which was one of those key measures. That's actually better for me now, because now I'm getting more in rent over time. Those rents are increasing, and the property's going up by more in value, and so we're actually ending up with a better return. So you're ending up with 100 grand more out of that. And the flip side then is, you said, okay, I think some of these you do need to keep into account, that there are factors that go into it. So if inflation is going to be 3% over that time period, maybe interest rates might be 6.5%. And if that was the case, that's just going to trash the returns. You're going to be underwater if you're looking at 6.5% interest rates over that time frame. Anyway, so that's sort of roughly the what it is. Encourage you to jump on, have a look around, have a play with it. The key idea really is that that property prices are anchored to something, whether it's just the cost of servicing a mortgage for it versus a wage, or it's the cost of servicing a mortgage versus what you could buy alternatively from a rent. And you can change those around. If you want to go back now and say, well, rather than mortgage cost of rent, now let's do it as mortgage cost of wages. And I think it's going to come back to 50% in Melbourne over that time frame. And what does that actually mean? And go around and play with those. See what happens under your assumptions. I think I've got all the questions with that. Thanks for listening in. We are on every Thursday, 12:30. We're actually going to do a little bit of a series on property. I think there's one of the key things we want to start pushing to people, particularly anyone out there who's watching this and is a first home buyer, is that you can save a lot of money if you're saving for a house. You should be doing it where you can through the first home buyer super scheme. And what does that actually mean? Well, it's not actually about using your super for housing. Don't sort of mistake that as I think there's a lot of people who hear that the terminology and think, oh, it's about using my super for houses, and actually no, I just want my super for my retirement. I don't want to mix and match. What it's actually about doing is using your tax rate in your super for while you're saving for your house. And if you're on a marginal tax rate of 30% and you can get a marginal tax rate of 15%, well, you've just you're a long way closer. So the example I keep using is, say you want to save $1,000 of pre-tax money, and you're on 100 odd thousand in salary. Then I want to save $1,000 of pre-tax. Well, by the time it hits my bank account, it's had tax taken out of it, I'm probably back down to about $680. If instead I took that $1,000 and stuck it into my super fund, now it's $850. So I've gone on day one, I've gone from $680 to $850. I made a 20% plus return just on day one from having that lower tax rate within your super. There are some pitfalls and some downfalls. So certainly, if you want to talk through this, have a look at some of the stuff we've written on it. We will be running some more podcasts on that. The message very much is, book in to have a call with one of our guys. You see all the links, and we can talk that through what it might mean for you. But certainly well worth doing if it fits your income levels and how much you have in super and things like that. Anyway, sorry, as I was wrapping up there for a minute, you can grab our stuff every Thursday, 12:30. We're on a whole bunch of different podcast channels on YouTube as well. Lots of questions in there today. Love to see people jumping in, asking questions. And we will see everyone again next week.